1962. Thursday evening. A kitchen table in Detroit, Michigan. Robert and Helen Martinez sit with a single sheet of paper, their monthly budget, written in pencil in a spiral notebook. Robert earned $98 this week as a factory machinist at General Motors. Their mortgage payment is $87 monthly. They have no car payment. They saved for 3 years and bought their 1959 Chevrolet with cash for $1,850. They have no credit card debt because they own no credit cards. Their only debt is the mortgage, taken out in 1958 when they bought their house for $14,500 with a $3,000 down payment they'd saved since their wedding. Total household debt, $11,500, roughly 1.5 times Robert's annual income of $7,600. The Martinezes aren't unusual, they're typical. In 1962, the average American household carried debt equal to about 55% of annual income, and most of that was mortgage debt. Today, the average American household carries debt equal to roughly 145% of annual income. Mortgages, car loans, credit cards, student loans, medical debt, personal loans. We owe nearly 3 times what our grandparents did, adjusted for income. Why? The simple answer is that credit is easier to get now. The real answer is more complicated, involving changes in what debt means, how it works, what it costs, and why people needed less of it when life itself cost less. Understanding why people had less debt requires understanding what was different about earning, spending, and living in an era when owing money carried shame and cash was king. The cultural attitude toward debt in the 1950s and 1960s was fundamentally different from today's normalization of borrowing. Debt was associated with failure, poor planning, or desperation. People who owed money, beyond a mortgage, which was acceptable, often felt genuine shame about it. This wasn't just personal preference, it was cultural messaging reinforced everywhere. Churches preached against debt, citing biblical warnings about bondage to lenders. Schools taught that saving before buying was virtuous, that borrowing for consumption was weakness. Families passed down the message that if you can't afford it, you don't buy it. The Great Depression had scarred an entire generation. People who lived through the 1930s remembered bank failures, foreclosures, unemployment, breadlines. They watched neighbors lose homes because they couldn't make mortgage payments. They saw families destroyed by debt they couldn't repay. This trauma shaped attitudes for decades. Parents who survived the Depression taught their children to fear debt, to save obsessively, to buy only what they could afford immediately. This cultural conditioning was powerful. A 1960 survey found that 60% of Americans believed buying on credit was morally wrong, except for houses and possibly cars. By 1980, that number had dropped to 35%. Today, it's under 10%. The shift reflects changing attitudes, but also changing economic reality. In 1960, you could often avoid debt if you were disciplined and patient. Today, avoiding debt while achieving major life goals, education, home ownership, even reliable transportation, is far more difficult. The culture condemned debt partly because people genuinely had more ability to live without it. But the moral weight attached to borrowing created powerful behavioral constraints.
If owing money meant you were foolish, weak, or irresponsible, you thought very carefully before taking on debt. Social pressure enforced financial discipline in ways modern individualism doesn't. Credit cards didn't exist for most Americans until the late 1960s and didn't become ubiquitous until the 1980s. Before credit cards, consumer debt was difficult to accumulate. You could get installment loans for specific purchases, furniture, appliances, occasionally clothing, from stores or finance companies, but these required applications, credit checks, paperwork, and often co-signers. The friction in the system made borrowing inconvenient enough that people avoided it unless absolutely necessary. The first general-purpose credit card, Diners Club, launched in 1950 but served primarily wealthy business travelers. Bank of America introduced the Bank AmeriCard in 1958, which eventually became Visa, but adoption was slow. In 1970, only 16% of American families had a bank credit card. By 1980, that rose to 43%. By 2000, over 70%. Today, the average American has 3.9 credit cards. The transformation was deliberate. Banks realized that consumer lending was enormously profitable and worked aggressively to change cultural attitudes. They marketed credit cards as convenient, modern, sophisticated, tools that smart people used, not desperate people. They offered cards to college students, people with thin credit histories, anyone they could sign up. They raised credit limits automatically, sent pre-approved offers constantly, made borrowing as frictionless as possible. And it worked. Credit card debt in America went from essentially zero in 1970 to $620 billion by 2000 to $930 billion today. The average household with credit card debt now carries roughly $6,800 in revolving balances, paying 18 to 24% annual interest. In 1962, carrying that kind of high-interest consumer debt was nearly impossible because the products didn't exist. You couldn't accumulate $6,800 in credit card debt when you didn't have credit cards. This seems obvious, but it's crucial. People had less debt partly because mechanisms for easily accumulating debt simply weren't available. The financial system was less sophisticated, less predatory, and less focused on consumer lending as a profit center. The cost of major purchases relative to income was fundamentally different, making it more feasible to save up and pay cash. In 1960, the median household income was $5,600 annually. A new car cost approximately $2,600, less than half a year's income. A basic refrigerator cost $300, about 5% of annual income. A television cost $250, roughly 4.5%. Compare this to today. Median household income is approximately $75,000. A new car averages $48,000, nearly two-thirds of annual income. These ratios matter enormously. When a car costs 6 months of income instead of 8 months, saving to buy it outright becomes realistic. When it costs 8 months of income or more, financing becomes almost necessary for most families. Housing shows the same pattern but more dramatically. In 1960, the median home price was $11,900, about 2.1 times median household income. A 20% down payment meant saving $2,380, achievable over 3 to 4 years for a disciplined middle-class family earning $5,600 annually. Today, median home price is approximately $420,000, 5.6 times median income. A 20% down payment is $84,000, which would take the average family 11 years to save if they put away every penny of a 10% savings rate. Few people can wait 11 years to buy a home, so they either borrow more, putting down 5 or 10% and taking larger mortgages, or they don't buy at all. The math simply doesn't work the same way. This isn't about people today being less disciplined or less willing to save. It's about the relationship between earnings and costs fundamentally shifting. When major purchases were more affordable relative to income, people could realistically save for them. When they became less affordable, debt became not a moral failing, but a practical necessity for maintaining middle-class life. The system that once rewarded patience and saving now almost requires borrowing for many families to achieve basic stability.
College education provides perhaps the starkest example of how costs have changed relative to debt necessity. In 1960, average annual tuition at a public four-year university was approximately $250, roughly 4.5% of median household income. A student could work a summer job earning $1.50 per hour, 40 hours per week for 12 weeks, and earn $720, nearly 3 years of tuition. Add a part-time job during the school year, and college was genuinely affordable without loans for many students. Room and board added costs, of course, but the total expense of a four-year degree at a public university was roughly $4,000 to $6,000 for tuition alone, achievable through work, modest family contributions, and minimal borrowing. Today, average annual tuition at a public four-year university is approximately $10,500 for in-state students, roughly 14% of median household income. A student working the same summer schedule at today's federal minimum wage of $7.25 per hour earns $3,480, enough for one-third of 1 year's tuition. The ratios have inverted completely. Work can no longer fund education the way it once did. The result is student loan debt, which barely existed as a large-scale phenomenon before 1980. In 1970, total student loan debt in America was under $10 billion. Today, it exceeds $1.7 trillion, held by roughly 43 million borrowers. The average student loan borrower now graduates owing $30,000 to $40,000, debt that will take 10 to 20 years to repay. This debt didn't exist for previous generations, not because they were more responsible, but because they didn't need it. Education was affordable enough to pay for through work and modest family support. The explosion in college costs, driven by reduced state funding, administrative bloat, amenities, arms races, and the availability of easy federal loan money, created a debt burden that earlier generations never faced. When people ask why millennials and Gen Z carry more debt than their parents or grandparents, student loans are a massive part of the answer. The debt exists because the cost structure changed, not because the borrowers are less wise. Wages kept pace with productivity and cost of living much more closely in the post-World War II era through the mid-1970s, creating economic conditions where saving was genuinely easier. Between 1948 and 1973, productivity in the United States increased by 96.7%, and average hourly compensation for workers increased by 91.3%, nearly matching productivity gains. Workers shared in the economic growth they helped create. Their wages bought more each year. Raises weren't just cost of living adjustments, they were real increases in purchasing power. This meant families could save meaningful amounts without severe sacrifice. In 1960, a factory worker earning $5,600 annually could save 10%, $560 per year, and still live comfortably because housing, food, transportation, and other basics consumed a smaller percentage of income. After 1973, this relationship broke down. Between 1973 and 2020, productivity increased by 61.8%, but average hourly compensation increased by only 17.5%. The gains from increased productivity flowed overwhelmingly to capital, corporate profits, executive compensation, shareholder returns, rather than to workers' wages. This divergence means modern workers produce far more value per hour, but take home a smaller share of that value. The practical effect on debt is straightforward. When wages don't keep pace with costs, people either reduce their standard of living or borrow to maintain it. Many choose borrowing. They finance cars they once would have saved for. They carry credit card balances for expenses that once fit within monthly budgets. They take out home equity loans for repairs or improvements they can't pay for in cash. The debt isn't primarily about poor choices. It's often about wages not covering what they once did relative to living costs. The economic structure that made low-debt living feasible, strong unions, high marginal tax rates on top earners creating pressure to pay workers well, regulated banking, government investment in education and infrastructure eroded significantly after 1980. What replaced it was an economy where credit filled the gap between stagnant wages and rising costs.
The way people bought cars in the 1950s and 60s illustrates how different the relationship with debt was. Car loans existed, certainly. Installment credit for automobiles dated back to the 1920s, but they were shorter term and required larger down payments than today's auto financing. A typical car loan in 1960 required 30 to 50% down and ran for 24 to 36 months maximum. If you bought that $2,600 car with a loan, you put down $1,000 to $1,300 in cash, money you'd saved, and borrowed the rest for 2 to 3 years. Monthly payments on a $1,600 loan at 6% interest for 36 months ran about $49. The loan was paid off quickly, and you owned the car free and clear. Many families simply saved until they could buy a car outright. They drove their current car longer, saved systematically, and purchased the next one with cash. This was considered normal, even admirable. Car dealers offered discounts for cash purchases. Financing cost extra. Today, the average new car loan runs 68 months, over 5.5 years. Many stretch to 72 or even 84 months. The average loan amount is $40,000. Down payments have shrunk to 10 to 15% or disappeared entirely with zero down promotions. People are making payments on cars for 6 or 7 years, often longer than they keep the vehicle. They trade in cars with negative equity, owing more than the car is worth, and roll that negative equity into new loans, creating debt spirals. The monthly payment becomes the only number that matters, not the total cost or the length of the obligation. This shift happened gradually. As cars became more expensive relative to income, dealers and lenders extended loan terms to keep monthly payments manageable. A $48,000 car is unaffordable at 36 months for most buyers. Payments would exceed $1,400 monthly. Stretched to 72 months, payments drop to roughly $750. Still substantial, but seemingly manageable. The cost is years of debt and thousands in additional interest, but the alternative for many people is not buying a car at all, which in most of America means not getting to work.
Medical debt is another category that barely existed for previous generations, but has become a major source of household debt today. In the 1960s, medical care was significantly cheaper, health insurance was more common among employed workers, and the uninsured could often negotiate payment plans directly with doctors and hospitals without involving collection agencies or credit reporting. A hospital stay in 1960 might cost $300 to $500 total, expensive but manageable for a middle-class family, and often payable in installments directly to the hospital at zero interest. A doctor's visit cost $5 to $10. Prescription medications were affordable. The entire healthcare system operated at a scale where medical expenses, while sometimes burdensome, rarely became catastrophic debt. Today, medical debt is the leading cause of personal bankruptcy in America. Approximately 41% of American adults carries some form of medical debt, with the average amount ranging from $2,000 to $10,000, depending on the study. Even people with insurance face substantial debt from deductibles, copays, and out-of-network charges. A single emergency room visit can generate thousands in bills. A surgery, even with insurance, might leave you owing $10,000 or more. Cancer treatment, chronic illness management, or a complicated childbirth can create six-figure debt. This isn't because people today are less healthy or more reckless with medical spending. It's because healthcare costs have increased at rates far exceeding inflation and wage growth, and because insurance has shifted more costs onto patients through high-deductible plans and reduced coverage. In 1960, employer-provided health insurance typically covered 80 to 100% of medical costs with minimal patient contribution. Today, the average deductible for employer-provided insurance is over $1,600 for individuals and $3,000 for families, meaning you pay that much out of pocket before insurance covers anything. For people living paycheck to paycheck, an unexpected medical bill becomes debt by necessity, charged to credit cards or financed through medical payment plans at high interest rates. Previous generations didn't carry medical debt at scale because they didn't face these costs. When people had less debt in the past, the absence of crushing medical expenses was a significant factor.
The practice of layaway, common from the 1930s through the 1980s, represented a fundamentally different approach to purchasing that reduced debt. Layaway worked simply. You selected an item, clothing, toys, appliances, whatever the store offered, and the store held it for you while you made regular payments, typically weekly or bi-weekly. Only when you'd paid the full price could you take the item home. No credit involved, no interest charged, just patient saving toward a specific goal. Department stores, clothing retailers, and toy stores all offered layaway. During the holiday season, parents would put toys on layaway in October or November, make payments through December, and pick up the items just before Christmas. The discipline was built into the system. You couldn't have the item until you'd paid for it completely. This enforced delayed gratification and prevented debt accumulation. You wanted something, you saved for it systematically, and you got it only when you could afford it. Stores benefited by securing sales and holding inventory. Customers benefited by avoiding credit card debt and interest charges. The system worked as long as people accepted waiting. Layaway declined in the 1990s and 2000s as credit cards made immediate gratification possible. Why wait 3 months making layaway payments when you could charge it to a credit card and take it home today? The convenience was real, but so was the debt. Credit cards transformed "I can't afford this now" into "I can afford the minimum payment." The psychological shift was enormous. Layaway forced the question, "Can I actually afford this?" Credit cards changed it to, "Can I make this month's payment?"
One question encourages restraint, the other enables accumulation. Some stores have brought back layaway in recent years, recognizing demand from customers who want to avoid debt, but it remains a tiny fraction of retail compared to its mid-century prevalence. The decline of layaway and similar pay-before-you-take systems removed a structural constraint that had kept consumer debt lower. When buying required saving first, people bought less and borrowed less. When buying required only minimum credit approval, both buying and borrowing exploded.
Interest rates on consumer debt were significantly lower during much of the mid-20th century, and usury laws, state regulations capping maximum interest rates, protected borrowers from predatory lending. Through the 1970s, most states had usury caps ranging from 6 to 12% annually on consumer loans. Lenders couldn't legally charge more, which meant they were selective about who they lent to and couldn't profit from high-risk borrowers through exorbitant rates. This kept credit less accessible, but also less dangerous. If you qualified for credit, you paid reasonable rates. If you didn't qualify, you couldn't borrow at all, which was arguably better than borrowing at 24% interest. In 1978, the Supreme Court ruled in Marquette National Bank versus First of Omaha Service Corp. That national banks could export the interest rate laws of their home state to customers nationwide. This effectively eliminated state usury caps. Banks incorporated in states with no interest rate limits, South Dakota and Delaware, changed their laws to attract banks, and suddenly could charge whatever rates they wanted to customers anywhere. Credit card interest rates, which had averaged 12 to 15% in the 1970s, jumped to 18, 20, 24% or higher by the 1990s. Today, credit card rates average 20.4%, with many cards charging 25 to 30%. Payday loans, which emerged in the 1990s, charge effective annual percentage rates of 300 to 400% or more. These products didn't exist when usury laws protected borrowers, and their existence has created debt traps for millions. A family in 1965 paying 8% interest on a loan could manage repayment far more easily than a family today paying 24% on credit cards or 300% on payday loans. The mathematical reality is that high interest rates make debt far more difficult to escape. You can make payments indefinitely and barely reduce principal. Lower historical interest rates meant debt, when taken on, was less likely to become permanent. The structural change in interest rate regulation fundamentally altered the debt landscape, making borrowing both more accessible and more dangerous.
Social safety nets and employment stability were stronger in the post-war decades, reducing the need for debt during emergencies. In the 1950s through 1970s, union membership peaked at about 35% of the workforce. Union jobs offered not just higher wages, but comprehensive benefits: health insurance with low or no employee premiums, pension plans that required no worker contributions, paid sick leave, paid vacations, job security through seniority systems. Workers at General Motors, Ford, steel mills, manufacturing plants across America enjoyed middle-class stability without college degrees. They could support families, buy homes, save money, and retire with dignity. This stability meant unexpected expenses were less likely to trigger debt spirals. If your union job provided fully covered health insurance, medical bills didn't become debt. If you had a pension, you didn't panic about retirement savings. If your job was secure through union contracts, you didn't carry credit card balances as emergency funds against potential layoffs. The social infrastructure supported working families in ways that reduced debt necessity. Today, union membership has fallen to about 10% of the workforce. Most jobs offer health insurance with high deductibles, no pension, limited sick leave, and no job security. Workers are classified as independent contractors to avoid benefit obligations. The gig economy offers flexibility but no safety net. When emergencies hit, car repairs, medical bills, job loss, people without savings and without strong safety nets turn to credit cards, payday loans, or personal loans. The debt fills the gap that unions, pensions, and comprehensive employer benefits once covered. This isn't about individual irresponsibility, it's about structural changes in employment and social support that shifted risk from employers and government onto individuals. When individuals bear more risk with fewer resources, debt becomes the shock absorber. People in the 1960s had less debt partly because they faced fewer financial shocks and had better protection when shocks occurred.
The financial industry's business model changed fundamentally, shifting from relationship banking to debt as product. Mid-century banks made money primarily through the spread between interest paid on deposits and interest earned on loans, and through fees for services. They wanted borrowers who would repay reliably because defaults hurt profitability. They had incentive to lend conservatively and to customers they knew. The relationship mattered. Your banker knew you, knew your history, wanted you to succeed because your success meant their success. This system wasn't perfect. It enabled discrimination and excluded many worthy borrowers, but it didn't encourage reckless lending. Starting in the 1980s, financial deregulation and securitization changed everything. Banks could now originate loans and immediately sell them to investors, removing risk from their books. This created incentive to make as many loans as possible regardless of borrower ability to repay, because the bank wouldn't hold the risk. Mortgage-backed securities, credit card debt bundles, auto loan packages, all allowed banks to profit from origination fees while passing risk to investors. The result was an explosion of available credit with weakened lending standards. Subprime mortgages, no documentation loans, credit cards to people with poor credit history all became common because banks could profit from making the loan and then sell the risk. This reached its catastrophic conclusion in the 2008 financial crisis, but the underlying model persists. Financial institutions now make enormous profits from consumer debt, particularly from borrowers who carry balances and pay interest indefinitely. The ideal customer isn't someone who borrows responsibly and pays off quickly. That customer generates minimal profit. The ideal customer maintains revolving balances, makes minimum payments, occasionally incurs late fees, and remains in debt for years. The credit card industry collected $130 billion in interest and fees in 2022 alone. This creates incentive to make credit easy to get and hard to escape. Banks send pre-approved offers constantly, raise credit limits automatically, offer balance transfer promotions that extend debt rather than resolve it. In the 1960s, banks wanted you debt-free because that proved you were a good customer. Today, banks want you perpetually in manageable debt because that's where profit lives.
Government policy actively encouraged debt accumulation through tax incentives and deregulation that previous generations didn't face. The mortgage interest deduction, created in 1913, became increasingly valuable as home ownership expanded and tax rates rose. By the 1950s through 1980s, homeowners could deduct mortgage interest and effectively reduce the cost of borrowing. This made sense when it applied only to primary mortgages, but it expanded to cover home equity loans and lines of credit, actively encouraging people to borrow against their homes for consumption. The Tax Reform Act of 1986 eliminated the deductibility of interest on most consumer debt, car loans, credit cards, personal loans, but preserved the mortgage interest deduction. This created incentive to convert consumer debt into mortgage debt through home equity borrowing. Banks marketed this aggressively. Why pay 18% on credit cards when you can pay 7% on a home equity loan and deduct the interest? Millions of homeowners did exactly this, consolidating credit card debt into home equity debt. The interest rate was lower, true, but they'd converted unsecured debt into secured debt backed by their homes. When the 2008 housing crash came, people lost homes partly because they'd borrowed against equity to pay off credit cards or fund consumption. Government policy had encouraged this behavior through the tax code. Student loans received similar treatment. The federal government became the primary lender for college education, making loans easily available regardless of ability to repay or likelihood that the degree would generate sufficient income. The loans couldn't be discharged in bankruptcy, unique among consumer debt, giving lenders zero risk and students maximum obligation. This policy enabled colleges to raise tuition dramatically because students could borrow whatever the school charged. The debt explosion in higher education was policy-driven. Deregulation of the financial industry in the 1980s and 1990s, repeal of Depression-era protections, elimination of barriers between commercial and investment banking, reduced oversight, enabled the proliferation of complex financial products and predatory lending practices. Previous generations lived under tighter regulation that limited what financial institutions could do. Those limits reduced innovation, but also reduced harm.
Cultural messaging changed dramatically, shifting from save first, buy later to buy now, pay later as the normalized approach to consumption. Advertising in the 1950s and 1960s certainly encouraged spending, but credit wasn't typically part of the pitch. Ads showed products, emphasized quality and durability, suggested you'd want to own this, but didn't usually mention financing. By the 1980s and especially the 1990s, advertising explicitly promoted credit, no money down, 0% financing, no payments for a year. The message shifted from save up for this to you can have this today, don't wait. This wasn't accidental. As consumer credit became more profitable for financial institutions, they funded marketing campaigns to change attitudes. Credit card companies sponsored sports stadiums, advertised constantly on television, sent billions of direct mail offers. They wanted to eliminate the stigma around borrowing and rebrand credit as smart money management. They largely succeeded. By the 2000s, using credit for everyday purchases was completely normal. Groceries, gas, coffee, all charged to cards. The friction between wanting something and having it essentially disappeared. This psychological shift enabled debt accumulation that previous generations would have found shocking. Television shows and movies reflected changing attitudes. In 1960s sitcoms, characters worried about bills, saved for purchases, celebrated paying off debts. By the 1990s and 2000s, characters casually carried credit cards, rarely discussed debt, and treated spending as entertainment. Retail therapy became a concept, shopping as emotional regulation regardless of ability to pay. The normalization of debt as a lifestyle rather than a temporary necessity or emergency measure
fundamentally changed behavior. When everyone around you carries debt, when advertising tells you it's smart, when the culture no longer attaches shame to borrowing, the behavioral constraints that kept previous generations' debt lower simply evaporate. People had less debt in the past, partly because cultural shame and social pressure discouraged it. That's largely gone now.
People had less debt in the past because the economic structure, cultural attitudes, available credit mechanisms, and cost of living ratios all combined to make lower debt living both possible and expected. They didn't necessarily possess superior character or discipline. They lived in a system where wages covered more, major purchases cost less relative to income, credit was harder to access, interest rates were capped by law, social safety nets were stronger, and cultural messaging discouraged borrowing. When those conditions changed, when wages stagnated, costs soared, credit became ubiquitous, regulations disappeared, social safety nets weakened, and culture normalized debt, borrowing increased dramatically. Some of this represents genuine progress. Access to credit allows people to smooth consumption, handle emergencies, invest in education, and buy homes who couldn't otherwise. Credit cards offer convenience and fraud protection. Student loans enable social mobility. Not all debt is bad, and not all aspects of the low-debt past were good. That era also featured exclusion, discrimination, and limited opportunity for many. But the scale of modern debt and the ease with which it accumulates creates real harm. Millions of Americans are trapped in cycles of high-interest debt they can't escape, sacrificing future financial security for present consumption they often can't avoid. The average household pays over $1,000 annually in credit card interest alone, money that could build savings, fund retirement, or reduce financial stress. Understanding why people had less debt doesn't mean we can or should return to 1960. We can't recreate those economic conditions. But we can recognize that massive household debt isn't inevitable or natural. It's the result of specific policy choices, structural changes, and cultural shifts, many of which benefited financial institutions at the expense of borrowers. If you found this exploration of debt history valuable, please like and subscribe. In the comments, share your perspective. Do you remember when your family avoided debt? When did that change? What do you wish younger generations understood about borrowing? Next, I'll explore how families saved for retirement before 401ks existed. Thank you for watching.